Good afternoon, ladies and gentlemen. Welcome to, I think this is the last session this afternoon. I hope you're all still awake. I have with me a panel of five. They've all done projects in this part of the world, and they're here to tell you about their experiences and what the different countries could do to encourage more infrastructure. In the morning, the Vice President of Côte d'Ivoire mentioned that he's expecting, or he needs to have 60 billion or so over the next 4 or 5 years to do infrastructure in Côte d'Ivoire. And of this amount, he's expecting the private sector to come up with more than 60%. So that gives you the lay of the land. That tells you what must be done by the private sector, or what the governments expect the private sector to do to make this happen. What I'll be asking my fellow panelists is, from their experience, what would they like to see from the government and the regulators to encourage them to step up to provide this 60 or 70% of money which will be required to do projects all over Africa, not just in Côte d'Ivoire. I suspect the 60% is typical of most African countries. So first off, Pierre, who is VP with the ADB, he specializes in infrastructure and industrialization. What are your thoughts?
So thanks. First, a pleasure to be here with you this afternoon. And so fundamentally, I think we need to find ways for government and private sector to work better together. And we at the African Development Bank happen to have a business where governments are our clients, 75% private funds, and private companies, the other 25%. So what we would like to do more of, really, is to get from you what is it in specific countries that we can do with government to make these sectors more investable, on the one hand. And on the other hand, and we can discuss that later, is also, since infrastructure tend to be longer-term projects, what is it that we can do to help develop local capital markets and other instruments to help accelerate exits and makes exits more easy for private equity funds and other funds. So what I'm really interested in exploring further, and what we want to do, is not just be LPs and financiers and investors in some of these infrastructure funds, but also work on the broader ecosystem where we help governments become better partners, because basically all infrastructure projects by and large are with governments, and so you need to strengthen that part to have a more vibrant and growing sector. And the Vice President Cablan, Duncan, mentioned it this morning. The needs are huge. We know the numbers. They're billions, they're trillions globally, and we need to find really this more powerful interaction between public and private sector.
Thank you, Pierre. Tosin, you've done projects in Nigeria, Ghana. What have you seen, and what would you like to see?
Thank you, Theo. At Africa Terminals, we see infrastructure a little beyond the basic definition. We see it as bringing, meeting the consumers' needs in the various places that we operate in. So we've done a project in Nigeria, doing another one in Ghana. But what we find across West Africa, where we've been, is the ease of doing business is, pretty much difficult in those places. So we'd like to see an effort on the part of government to enable businesses and to encourage infrastructure development in those locations. Maybe government should also employ some skills that will match the counterparts, the people, the private sector entrepreneurs who are trying to establish those businesses and build infrastructure. We'd just like to see a bit more cooperation. And across West Africa, where we operate, West Africa is supposed to be integrated in ECOWAS, but we find that integration is more on paper than in reality. So we'd just like to see a little more integration across the region, and just for government to make it easier to come in as private sector people to do business in this location.
Thank you, Tosin. Next off is Opuyo. Tosin has mentioned a couple of things. He says that ease of doing business is something that needs to improve. He's also talked about the government acquiring skills I imagine that's skills to negotiate with the private sector. Do you see this as a problem, and how do you think the governments can deal with this?
Yeah, I mean, I certainly do. I mean, I look at it from two perspectives. One perspective is where government does know what it has to do. I think government should do less. Government should allow investors to get on with the job. We need to obviously have clear, transparent, and consistently applied regulation that we can all work towards. But sometimes, certainly in our experience, we find that there is also ignorance involved. It's what I call asymmetry of knowledge and experience. You have private investors who have done this several times. They've come along with, a strong team of people who understand the financials, the economics, the legal, the technical, all of those sorts of things. And very often you're dealing with a government department that is very under-resourced and doesn't quite know end-to-end, what is required to do. So it's always advisable, in my opinion, for government to take good advice that is in its team to help it negotiate when it's dealing with investors such as ourselves. I think a final point for me as well is really that point about consistency. It's such a very big point because, when you invest in infrastructure, it's a long-term play. And you don't want to, having committed a lot of money, suddenly find the rules are changed on you midstream. That can be extremely expensive. So we need government to have sympathy for that fact and be very, very careful how it approaches things.
Thank you, Puyo. Emeric, you have clients in the U.S. who are looking to invest in Africa. These points that have been made today, how do they affect the attitude of your clients?
Yes, that's right. Thank you for the question. So we are here representing a trade group of U.S. pension plans and insurance companies that are looking to invest more in infrastructure as a global asset, but with allocations to frontier markets, specifically Africa, for the enhanced returns and lower correlation that you can get by investing in infrastructure. Furthermore, there's an alignment between what they're looking for, which is long-term assets to match their long-term liabilities, and they can find that in infrastructure assets in Africa. But what is also important about these long-term investors is the cost. For infrastructure to be accessible and affordable in Africa, we need to be able to reduce the financial cost. And these long-term investors are able to provide long-term asset, which is also more affordable, which thereby can benefit consumers in Africa. And our model of getting them to invest in Africa is about co-investing. So we're actually partnering with local pension plans and the asset managers to invest with U.S. investors, and mainly U.S. pension plans and insurance companies. Another group that's not really talked about is endowments and foundations. This is another group of institutional investors that can even invest even longer term, that are even more global, and have a even better appetite for these types of transactions. So our initiative is about mobilizing these institutional investors to look at infrastructure as a global asset, because that's the way to invest, but also at opportunities here in Africa, because that fits their model. Furthermore, lastly, I'll just add that the National Association of Securities Professionals, which has signed an agreement with USAID, the U.S. Agency for International Development, to bring U.S. institutional investors to look at this market. We've often talked about DFIs working on getting projects to bankable status so that we can meet the demand of infrastructure here in Africa. But we also have to look at the supply. Where is the money going to come from? So therefore, we need to mobilize these investors to get them ready to invest in infrastructure, in assets in Africa. And that's what our partnership is getting ready to do. Thank you.
Thank you, Emeric. Jury, you have, shall I say, have seen it all. What are your thoughts on getting more money into this pool?
Thanks. Sitting at the end of the queue, so a lot of it's been said already. I think, we all always harp on about the framework and government needing to get more experience and the experiential gap, etc., that Opie is talking about. I fully agree with that. But I think it's incumbent upon ourselves as the private sector who want to play in infrastructure projects in Africa to ensure that the way that we're transacting is sustainable. Because if you're getting deals that are too good to be true, they're just too good to be true. And they will unwind in you. We're talking about a 20-year horizon here. And 5 years in, someone will come up the curve and understand that the deal that was done was exceptionally one-sided and it will fall over on you. Anywhere in the world, it will fall over on you. So I think it's incumbent on ourselves to do some basic sense checks. And we've seen some of these examples. If the unitary payment required on a toll road, for example, is 5% of GDP, understand that that's going to cause you grief somewhere along the line. If you're doing a power project that is well above the cost curve and you're not contributing to the decrease in tariffs, you take note of that up front. The fact that you're able to enter into the transaction shouldn't be comfort on its own. We have to understand that what we're dealing with here is an environment of ever learning and ever experiencing the experience gap closing over time. Not just over 20 years ago, there was not a single power regulator or electricity regulator on the continent. There's now 28 regulators. Half of those countries have done IPPs. So it is a process, and we're getting there. I think there's a couple of the sort of more specific issues, and political risk insurance is one of them. It's incredibly sensitive in any home country. Well, why do you want to take political risk insurance against us? I think if we can get governments to understand that in order to mobilize international capital into these markets, it's going to be a given. So let's not be sensitive about it. Let's just see it as a part of the process. And lastly, I want to touch on what you were talking about, Americ, which is, and two of the speakers this morning spoke about the changes in the Kenyan pension fund regulations, where 10% of capital is now investable in private equity anywhere in the world. We very much see the infrastructure asset class as an ideal long-term savers asset class. We believe that pensioners, long-term savers across the continent just don't have enough investable options. And I think we need to work very hard on changing the regulatory environment, the pension regulatory environments in all these countries in order to make this asset class accessible to local savers. It's got a huge benefit for us as private sector players. We want local participants in our projects. And at the same time, builds out the long-term savings asset classes in those countries.
Thank you, Jury. You've mentioned a number of things. Long-term savers coming in to help create liquidity. We'll come back to that. But let me quickly ask about the asymmetry in skill sets between the private sector and the government side. Now, up here, there is something called the African Legal Support Fund, which ADB has set up, and that provides support for legal services to governments to help bridge this gap between the skill sets. But what happens when, by the time you've gotten to drafting of the agreements, you may already have a bad deal, and the lawyers may not be able to fix it. I'm a lawyer, but there's only so much we can do. Are you looking at providing the same sort of funding for other areas like engineering, technical, consulting, that kind of stuff?
Thanks. No, I think it's a very good point. And so, first, we have a wide range of situations in Africa with some governments quite well equipped to really engage with private sector and negotiate and come to good agreements. But probably, I would say the majority of governments are not in that situation, and a large number are really extremely under-equipped, let's put it this way. And so while our legal facility, ALSF, is a critical kind of contribution to that gap, it is clearly not sufficient because, as you rightly point out, if your deal doesn't make economic or financial sense, the best lawyers in the world can't do much to save that. So I think we have a number of other instruments. We are, as I mentioned before, are a lender to governments, and we lend for physical infrastructure financing, but we also lend for technical assistance. We also provide grants, and we're an intermediary between multiple donors and our African clients. And one example of that is the NEPAD IPPF, which is the infrastructure project preparation facility that supports the NEPAD-PIDA priority action plan. So over the years, we have funded over $90 million in upstream studies and work to really prepare projects and get them to the bankable, financeable stage. That is much heavier, and it includes a whole gamut of services from the engineering side and to the legal side, the finance side, etc. So most of our client governments need strong capacity to negotiate. It's not part of traditional civil service, and that is a significant gap. So that's why we see many of these public-private partnership or these private transactions are accompanied by international sponsors like ourselves, Multilateral Development Bank or development agencies or other sponsors, and it remains an area where much work needs to be invested. One of the approaches that we have taken, and that many countries have taken, that we have supported a number of countries, is to help develop and support PPP units. And so the name is public-private partnership, which is not necessarily limited to, strictly speaking, PPPs, but these are units that then that represent the government instead of having the Ministry of Transport, the Ministry of Energy, the Ministry of what have you, kind of try to develop their own teams to engage in these projects. You have this central government unit. But those units, again, the track record is pretty uneven. So they need help, they need support, they need a lot of capacity building, and they will need, in most cases also, however good the teams may be, strong support from international advisors who understand the market, who understand the players, and who can kind of help the government get good deals. So a lot remains to be done. A lot is happening already, and we are quite keen to work with other partners to kind of help aggregate and provide a more kind of coherent set of support to governments that are interested and keen to engage in these transactions, as we've done, for example, in Côte d'Ivoire, where we're here today.
Thank you, Pierre. Merrick, let me ask you this. I know you don't work for the USTDA, but the USTDA does provide this kind of support in some cases.
Yes, it does. They do provide project feasibility assistance funds to help, again, bring projects to bankable status. And it's obviously costly to do project development, and TDA provide grants for that purpose.
Does that make your clients more comfortable? You know, having a project with this kind of a feasibility study?
Well, it certainly does, but from all members, which are mainly U.S. pension plans, when it comes to investing in infrastructure, specifically in frontier markets, they mostly do it indirectly. Pension plans, we say institutional investors as one word, but it's a very different groups. Canadian pension plans have been doing infrastructure deals for a while. They do directly in Colombia, Mexico, in other countries. But American pension plans, well, first, a lot of them are not doing infrastructure, even in developed countries. So now they're just starting to get into infrastructure as an asset class. Furthermore, when it comes to investing in infrastructure in developing countries, they will mostly do it indirectly. Now, many have already. Many have done it through private equity funds. And that's a model that they're very comfortable with. And my focus right now is to find the right private equity funds or other type of capital pools whereby they can, feel comfortable with the risk-return profile and the partners with who they're investing. So they would mostly do it indirectly through capital pools. But at the end of the day, how and where the investments are made, within the projects, it's very reassuring to know that the due diligence and project development and the governance have been done in a way that gives them the comfort that they need to invest. And that's why, again, I stress co-investing, because once you invest with local African pension plans who are, to many extent, also are not really engaged in infrastructure, but they work a lot with their asset managers. I have here, very experienced infrastructure investors. So that is a bit the model, co-investing with local pension plans, but for now it will be mostly through asset managers and other capital pools.
Thank you, Merrick. Jury?
Yeah, if I can just add to what Piers said there. I mean, I hate to use the South African Renewable Energy Program as an example yet again. And as it turns out, for 3 years it was a brilliant example. The last year it hasn't been the greatest example anymore. But the program started out, A, with the right will. B, had exceptional promoters, internal government promoters. So there were particularly 2 individuals who really pushed very, very hard. But most importantly, they were given the checkbook to get the best advisors at the technical level, the legal level, at financial advice. The full set of advisors were top class. So the program was exceptionally well designed. And once it took off, it gave a huge amount of consistency and confidence from the private sector to come in. They then charged, on every project that closed, they charged a fee, which went back into the coffer for future advice to take place. And if one can get that self-sustaining rolling process that you ensure that government's always got top-class advisors, it really works. And we see some of this replicating now, the scaling solar programs, etc., coming through.
Well, thanks, Jury. So what you're saying is that each project was taxed a small amount, which went into a fund to finance advisors for the next.
Well, it was essentially a recoupment of top-class advice, but it's obviously ended up, as the program rolled out more and more, they just kept charging the same fee. So there must be a kitty building up there which can be used on future programs and can be diverted into sort of other strategic areas.
Yeah, thank you. Now let's look at where the money can come from. I mean, we've talked about what might encourage you to do a project, but to do a project, you need to have the money. Money can come from, you've mentioned pension funds, and we've talked about the regulations in countries not allowing pension funds to invest in infrastructure. But in many countries, that's changing or has changed, and they can invest, but they don't appear to be doing so. So it looks like there might be some other problem as well. Opuye, what do you think?
There are challenges, but I think let's first of all just put things in context. If you're looking at where the sources of money for infrastructure projects in Africa comes from, I think you'll probably find there are about 4, maybe top 5 key blocks. You've got multilaterals, support from the World Bank, not necessarily direct loans, it might be guarantees like PRGs and PRI. You've got DFIs like the African Development Bank, IFC, and others who will also come in, both on the debt and equity side, and they will give you guarantee and other types of support, et cetera, et cetera, et cetera.
But they would tend to come in after you've got the bulk of your money from somewhere else.
Not necessarily. I mean, you'll actually find, my own experience is that typically about 70, maybe 80% of the capital that comes into infrastructure projects in Africa are from offshore sources, and a large percentage of that are DFIs. And the reason for that is because, the DFIs are usually more willing to take risk. They help to catalyze markets where often others won't go, and they're able to sometimes provide that concessionary financing. Frankly speaking, local sources of finance are still very much at their infancy. So it's about also looking at newer sources of finance. And so when you're talking about pension funds and insurance funds, but I would put pension funds first, because in Africa, we have about $400 billion of pension funds, the largest of which is from South Africa, GEPF, Government Employees Pension Fund. I think thereafter you have Nigeria, you have Botswana, and a few others in there. And it's interesting hearing the strategy that America is pushing with the US pension funds, because the truth of the matter is this: you may not find a perfect alignment for what you want to do, in that you need to look at the individual regulations in each country. They're not all symmetrical. So, for example, like maybe in Kenya, yes, they've now changed their rules to be able to invest anywhere in the world. Nigeria did that quite a while ago. Botswana, surprisingly, can actually invest 70% of their total portfolio anywhere in the world that they want to. Ghana recently introduced new legislation, which I think is, by now should have now been passed, which enables them also to now invest in private equity and things like that, and also invest outside the country. So it really varies. But again, if you look, say, like a place in Nigeria, the pension funds are restricted on how they can participate in any infrastructure project. They can, for example, invest indirectly through infrastructure funds, and there's a certain limit, and they can only invest directly in the form of debt. So you have debt securities, which are a certain minimum credit rating, and these are typically listed securities. And very often, you don't start off a project with those types of structures. Now, I must put out a figure there, and this one, I think, causes people to blink a little bit. But if you look at the infrastructure need that we have to finance, my view is about 90 to 95% is greenfield. It doesn't exist, and you only have to go to a lot of African cities and see what happens in the roads, the water systems, the drainage systems, and all that sort of stuff. And you're not going to get into this nice brownfield stage unless you start with the greenfield stage. And that creates a conundrum because the pension funds don't want to take equity risk, even though there are ways, I think, of managing that. But if you don't do that, we'll never really get to any sizable, meaningful brownfield stage for your monster US pension funds to actually invest in. And this is something to think about.
Thank you, Puyo. So we have a situation where, you know, the projects will be greenfield, as you say, and so they're not attractive yet to pension funds and those types of people. So still the question is, where will the money come from? You know, Tosi, any ideas?
Thank you, Theo. I believe where the money will come from to the people who provide the money from an operator point of view, having identified the problems, I'd like to also speak to the opportunities that exist for infrastructure. The space that we're playing, which is the storage of refined hydrocarbons, we have a report that says there's a dearth of storage facilities in West Africa in terms of volume and location. Nigeria, for example, the daily consumption of refined products is about 65,000 metric tons. So if you look at the requirement for a country to have at least 3 months of consumption in reserve storage, we're looking at about over 6 million metric tons in storage. That is about all the storage we have right now. Half of that is owned by the state oil company, and the inland facilities with a collapsed pipeline infrastructure. There really is need to provide more storage. That's why we find that, and also the very few people who are in the storage business, you find that most of the storage facilities have also are used by traders and marketers for their own business. So there's no third-party storage. So there is an opportunity there, and we find that, we are booked month and month, for the facilities we have running now. So there is, and if you look at Ghana and Liberia and other countries of West Africa, it's the same story really. So I think so for us as operators, we need to show that opportunity, the opportunities and that exist, and I think the money people will follow.
I see. Okay, Yuri, do you agree with that?
Um,
Good projects will attract money.
Just repeat that, please. We're struggling to hear it on this end.
Good projects will attract money.
Good projects will attract money. I think it's 100% right. I think the comparison, greenfields versus brownfields. If you look at the developed markets where brownfields infrastructure projects can be accessed, there's a lot of money chasing a number of deals, and ever expanding exit multiples have, in our mind, caused that market to overheat somewhat. So looking forward, we don't see fantastic returns coming out of brownfields infrastructure in developed markets. So just simply the search for return and above what is relatively low levels these days will have people looking at greenfields and riding the curve through the construction phase. And when greenfields, we're talking about construction risk. We're not talking about complete greenfields development from day one. We're talking about just simply taking construction risk. We think that, that sort of construction phase has been, you can mitigate your risk in that construction phase. That's why we deal with tier one EPC contractors in executing projects. Not because we don't want to support the local guy. We want this local guy to be subcontracting to the large contractors. But we're looking for balance sheet rather than builders who can stand behind the obligations of an EPC contractor to deliver stuff on time and to spec. So that it's our belief that the greenfields infrastructure risk is somewhat overplayed, and that people are starting to accept that, and that money will come for good projects. Ultimately, where's the money going to come from? It cannot continue coming from the DFIs forever. It absolutely has to expand to the international institutions. That is the source of capital for infrastructure projects.
Thank you, Yuri. Now, you take, from your point of view, greenfields should start from construction. But between conceiving a project and starting construction, you've got licensing, permitting, concession negotiation, and that can take, in some jurisdictions, several years. So how do you manage that? Maybe I can ask Pierre what he's seen, because that is a phase that somebody needs to take up. If you don't do it, then you don't get to the phase you're talking about. And if you don't get to the phase you're talking about, you never get to the phase that Opuya is talking about.
A few points. First, clearly, infrastructure projects do have this longer gestation period. And so one of the challenges, it's a bit connects with what I said in the very beginning, is we need to go from a situation where we right now finance project by project. We'll need to find more wholesale mechanisms where, especially for the upstream part, the whole part that is involved in kind of the feasibility study, the negotiations, by getting things ready to be financed, get wholesale and not done on a project by project basis. And so that's what's one point. The second point is a bit about the comment that the jury and others have made. There's not more money going to come from DFIs, and by and large, there's not more money going to come internationally. I think the growth has to come from Africa. The delta has to come from Africa, and a growing part of that will have to come from the private sector. And the private sector means including the savers that you alluded to before. So finding, and that we have a role to play in that as well, is finding a way, one, to move the business towards a more wholesale model. I think that's, otherwise we'll keep kind of struggling through and having to do tenders for every single bit of every single process of every single project, one, and then two, finding ways to mobilize domestic resources more effectively and kind of creating vehicles that can kind of satisfy the increasing demand for higher yield savings from African citizens is part of the longer term challenge in a sense.
Okay, so he's saying that don't expect money from DFIs.
No.
Or don't expect as much.
The delta, this huge growth, the 50 billion gap that Vice President Duncan mentioned this morning,
has to come from the private sector.
The biggest chunk of that will have to come from the private sector, and the biggest chunk of that will have to come from Africa itself and from African investors and people and citizens and savings, etc. So, and that's what we need to kind of organize and channel more in a more deliberate manner.
Yeah. Thank you. Now, let me ask you, you say that we should find a way to make the process more standardized. And my question is this: how do you standardize infrastructure projects? Because no two projects are the same.
So clearly, it's more the upstream part is pretty much can be standardized. You need to do feasibility studies. You need to. So if each time for each project you have to start doing a tender for your engineers, doing a tender for and finding money to fund each one of these bits, that is the time-consuming process. This economies of scales and scope can be developed, and we need to move to a model that is a bit more of a wholesale model. I mentioned these PPP units. They are beginning, but they're only a beginning. But most of them still work on a project-by-project basis. And so where we can come in particular DFIs, I think where we will be increasingly be able to contribute to this growth in kind of filling this gap and this need for infrastructure finance in Africa is through the more innovative approaches and products to providing comfort and guarantee as opposed to providing a significant chunk of the actual financing itself.
Thank you, Pierre. So now, all this presumes that we're looking at an environment where there's stability of government. But in many parts of Africa, you have, conflicts, you have, fragile governments. How do you manage, and they need infrastructure as well. How do you deal with that?
So why don't I start on this one? I think it's a big challenge. And so when you look at Africa, of the 54 or so countries, about 22 are conflict-affected, post-conflict, fragile, in transition, pick your word. Those countries have huge infrastructure needs. And those are financeable, but they're much more difficult to find. So I think we need to find a bit of a compact where we kind of on the DFI side, the development community, and et cetera, help set up mechanisms that will facilitate investment, in particular in those more fragile environments. And some of it may have to come with some concessional dimension. That is that, you may need a bit more, you may need some element of subsidy in terms of getting private sector to invest in much higher risk environments. And so if you look at the broader trends in development finance, basically, by and large, a growing share of development finance is going to go to fragile states. It's happening already. That trend will accelerate. And so let's find vehicles to capture part of that stream. That stream is growing. To capture part of that stream to really leverage private investment and make it easier for private investors to finance infrastructure projects, in this case, in these environments.
Thank you. Let me ask Emerick.
Yes, I just wanted to add some comments about your question was still where the money will come from. We know that it's not going to come from commercial banks, right? They are not able, under their regulatory environment, to provide the long-term funding that infrastructure needs. We know that the DFIs have limited capacity as well. So I think in terms of where the money will come from, there's not many other options left, but looking at pension plans, insurance companies, endowments and foundations. More than that, we also know that based on a study done by Preqin, they looked at all the funds raised for infrastructure for investing in Africa from 2007 to 2017. And from that study, we know that 95% of the funding, private sector funding, came from offshore or international players. And only 5% was raised locally by local institutional investors. So from that study, we also know that international funds or international institutional investors are willing to play in this market because it fits how they view infrastructure as a global asset. So I do think, though, that we need to work on the issue of greenfield versus brownfield. And I do agree with Yuri that I think that ultimately we'll see more institutional investors be willing to take this type of risk. But I think, and they are already through funds, but I think that this is where the DFIs can even provide additional support without necessarily providing financing. They could provide additional credit enhancements during the construction phase, and this is the point that Yuri was talking about. And I think that will be a way to mobilize additional institutional investors into greenfield projects. And I do think that there's no other alternative because I agree with you that we have to tackle the greenfield risk issue and see how we can get additional institutional investors into taking that risk with the assurance that it can be mitigated.
Yeah, Yuri?
One thing I'd like to add in there, I really think, and the statistic is staggering, whether it's only 5% or 20% that comes from local financing. And Pierre, you made the point a number of times that we need to have a solution from Africa. Now, I'm not in any way saying that we shouldn't have international capital come in. I support it. I think all capital is welcome. But for me, my own experience dealing with international finance from both directions, both now sitting in Africa, attracting international finance, and sitting in Europe or America, Latin America, looking to put finance into Africa. One thing I always picked up was part of your due diligence was to ensure you had good local sponsors who know how things work. And the key question, therefore, is what is required to get local sponsors having that confidence to actually play in the market. Another Preqin statistic will show you that about a third of all institutional capital globally is actually from pension funds, that actually go into infrastructure. So, I'm looking at African pension funds. There's $400 billion, and, I'm not saying all of that goes into equity, but if you put a lot in equity and you work on what I call the leverage factor, first of all, you're not going to invest in the majority of the equity, and even when you partner with others, you co-invest with others in equity, you will then also get debt leverage as well that will come into that. When you add that number, it could work out to be a huge astronomical amount of money. The question is, therefore, ensuring that in addition to the foreign pension funds that are already more culturalized with saying, okay, we'll take some equity risk here, get some brownfield exposure indirectly. We need to be able to get the comfort into the local pension funds as well. Because without having a robust long-term pool of savings to support investment, investment won't really come. And the final point, I fully agree with Pierre. And when I raise the point about the majority of the capital I've seen coming into Africa comes from DFIs and multilaterals, the signal there is, listen, that can't go on forever. And it's not just that they have limited balance sheets or they need to go and focus on more, problematic areas. The critical thing is we need to be able to provide that enabling environment. So Tosin's point about ease of doing business, that will encourage even the local investors to say, yeah, I will take that risk and I'll do so consistently over the long term.
Yuri?
Let's just clarify here that what we're talking about is there's sort of two phases in the infrastructure investment life cycle. The first is the conception and permitting, etc., that you're talking about. And that's not a long-term savers spot. That is more akin to venture capital. And I think that's probably the biggest challenge, finding enough funding in that space to generate projects that are able to get to the point where they are genuinely as long-term savings assets that institutional savers can start looking at. So, yes, getting to a point where you can reach financial close and get through construction risk and your revenue line is secured and et cetera. That's, from that point onwards, I think it's a no-brainer. The point before that, getting projects from inception through the permitting phase, that's a cash-hungry phase that I think is our biggest challenge in finding pots of capital for.
Yeah, that's true. We don't have the answer to that. We talked about fragile states. Have any of you done a project in a country where the government wasn't that stable? Any takers?
Well,
Pierre says he has the financing for you.
I mean, some might argue that our current home countries aren't as stable as they should be, but I'm being very careful what I say in case this is being recorded. I think I think any country where you don't have consistency of policy is unstable. It's as simple as that. And Yuri's point about whether you call it venture capital or development capital is so critical to this. Because, you see, when you go into the development phase, there is no guarantee you will ever get to financial close. And therefore, that capital you expend is pure risk capital. If you then find governments flip-flopping and changing position left, right, and center, you're less inclined to want to put any money there, whether you're local or international. And so that issue about stability and predictability almost is essential to attracting capital. Look, one final point about infrastructure. Let's not forget the types of transactions we're doing when you compare them to maybe FMCG type of companies. These are huge outlays of capital over a long period of time. And so, you think twice about committing that capital. It's not like, I'll write off $1 million here. You could write off $10 million very easily. So you have to have that stability and predictability to build confidence. And the final thing I always say to governments is, listen, you need to create the environment where we don't just do one project here and wait 10 years. If we can start building a conveyor belt of projects, that itself creates that air of confidence and doability. And then you'll suddenly see the risk premium go down. There'll be less requirements to have guarantees because people can say yes. And if I do this, I'll get there, and there are more to follow and more have been done successfully. We haven't, unfortunately, gotten that critical mass yet, and that's a big problem.
Thank you. Yuri, you had something to say?
Well, perhaps one exception will be Kenya, actually, where I was there last week, and they've just started this massive initiative of highways and roads, which require about $3 to $4 billion per year, total of $14 billion. So they've actually gotten that knowledge that you need to have pipeline. And then if you do, for example, what happened in South Africa, where you have the renewables program, where they have different phases. And the first phase was much more expensive because the risk was unknown. But to your point, as you have a proven concept, the latter phases were actually much cheaper, and the tariffs were able to be passed on to the consumers.
Thank you, Americ. Yuri, you had something to say?
Oh, I think, just to your point about fragile states, and I think we will stay on a no-names basis. I think it's important to look at the specifics, locally. You know, you can sometimes you do high-level analysis and you go, no go. But in my experience in 2000, around about 2000, one of the first infrastructure projects I was ever involved in was the rollout of the MSI, which became Celtel, and so on, the networks. There was a particular country at civil war at the time, and we were rolling out a network in the middle of the civil war, and it was advantageous to both sides, and in fact it was the highest profit generator per capita in the, or per ARPU, or whatever, the terminology is, at the time. Currently we're doing a project in a country where you wouldn't take your wife to the north on holiday, but actually the southern part of the country is operating very well, and we're very confident about the project. So, you've sometimes got to look at some of the sort of local nuances and be objective about them.
Thanks for that. Let's look at exits. How does the availability of exit options and liquidity factor into your decision to do the project in the first place? Let's start with Tosin.
Thank you, Theo. But before I go into that, just to add very quickly to what Puyo said about, consistency of policy and all that.
Okay.
I think in this environment also we need to build institutions that function properly, like legal systems in West Africa, where a situation where judges are being arrested left, right, and center does not instill confidence in the legal system. It happened in Ghana and Mauritius and in Nigeria. But having said that, coming to the issue of exit, we have PE investors, and I think from day one, they always, before they go into an investment, they think of various exit options. So in our particular case, maybe they've thought of that, but generally speaking, I don't think there are enough options for exits for PE, in my opinion. Our capital markets, for example, in West Africa are not well developed. So if a PE firm is looking to go to that route to exit, it may be a bit difficult. And plus, PE is relatively new in this environment, so a lot of the funds have not reached exit stage, so we don't really know for sure, how easily they'll be able to exit their positions. But I think that we need to work consistently to develop the options. We've spoken about pension funds and insurance companies that like brownfield projects. Maybe those would be a source of exit. And also to develop the capital markets in our particular region, such that they're able to, offer exit options to fund providers.
Thank you. Opuyo, you've seen some exits. What are your thoughts? How does the exit options make impact on your initial decision to do a project?
There have been a few exit in the infrastructure space in Africa, albeit not too many of them. Your fund, you guys sold Bakwena Platinum Highway to AFC and other people like that. We exited the Lekki toll road. In the Azura IPP that we're both co-invested in, you had American capital sell out and Actis bought into that. So, there are some examples, but we haven't yet reached that volume that you're seeing in the general PE space. But it's absolutely critical. When you enter an investment, at least the name of our game in terms of being a greenfield-focused firm is where we look to earn a return for our investors is not waiting for dividend streams. It's actually the exit multiple. It's all about the growth story. So you have to think ahead about the 3, 4, 5, 6 potential ways that you will eventually be able to get out of whatever asset you go into. And you need to do that up front. But Tosin is absolutely right. There's still a lot of scope to deepen our capital markets. There's still a lot of scope to create an environment that will ensure that you can actually get these things moving more quickly. And in so doing also, I like to distinguish between territories like Southern Africa. South Africa, very often, you can't quite say it's like the rest of Africa. Sub-Saharan Africa is quite unique in terms of we're not as advanced. So I think it's important to be very sectorial and segmental in how we approach. Now, at the moment, if you look at the sequence in which we've seen infrastructure deals done, it's not untypical of other parts of the world. telecoms was, the first main thing, and the next thing is you see a lot of focus on energy like we're seeing today, transport, and for some reason water and wastewater tends to come last. So I expect that, where you'll begin to see major exits may probably be in the telecom sector before you begin to see some power exits. Of course, in South Africa, you were doing toll roads since 2000. So they've gone through a certain stage where they're now ready to get out of the market. But I would say the jury is out, like Tosin said. We still need a bit more time. But I'm not too troubled by it because these are long-term plays, and we see a lot of market reforms and development ongoing that will, I think, see us well in the next 5 or 10 years, as the case may be.
Thank you, Pio. Jury had something to say?
Yeah, I came into the infrastructure world from an old mutual perspective, which was, we've got the classic long-term saving, long-term liabilities. We want to match them with long-term assets. And actually, we looked at life, what turns out to be fairly naively, at these are infrastructure projects that are long-term self-liquidating, i.e. you get a 20-year concession and its dividend stream ultimately pay you back over 20 years and you're very happy. And that's actually how we fundamentally started out life, going, well, this is about securing this long-term cash flow stream. So I think there is scope here to start thinking about what the ideal entities are to actually ultimately hold these assets in terms of making them accessible to long-term savers.
Let's take any questions before we close. We've run out of time. No questions? Okay, I'll just... You have one? Okay.
Thank you, gentlemen. My name's Mark Kenderdine Davis. I'm from CDC. I do have a question for you. We've heard you talking about the huge infrastructure funding gap. We've heard you talking about the provision of capital by MFIs, DFIs, endowments, pension funds, etc., plus the all-important local institutional capital. But I haven't heard any of you mention Chinese capital. And do any of you foresee in the coming years a cooperation between the pools of capital I think you're referring to and pools of Chinese capital to fill that infrastructure funding gap?
For some reason, we're not quite hearing everything you're saying. I don't know.
Right. Is that clearer?
Yes. Thank
Great.
you.
Okay. I'll do it quickly this time. Huge infrastructure funding gap. You referred to pools of capital that might fill it, both international and domestic. But I don't think I've heard any mention of Chinese capital. So what I'm interested in is, do any of you foresee cooperation between pools of the sort of capital you're referring to and Chinese capital? Or when you're referring to international capital, are you indeed including Chinese capital?
Okay, so your question is whether they're looking at sources which are government to government, as the Chinese government or some other government funding infrastructure in Africa. That's your question.
And cooperating with the pools of capital you're talking about now.
So, from the African Development Bank, clearly China is one of our shareholders. China has provided financing that is available to us to help co-invest in some of our, on the debt side, in some major projects. And so we are very keen to find ways to work more effectively with Chinese capital and enterprises. And we have a number of partnerships that we're rolling out, and I think that's it's something absolutely essential. They are a major source of infrastructure finance on the continent, and today we have a bit of a segmented reality. We're here, and then they're somewhere else, and we have to find a way for more effective collaboration. So we have started at African Development Bank, but it's a beginning, and I think we can do much better in kind of bring them in and finding also opportunities where we can actually do joint financing with the international community, but also the local pension funds and sovereign wealth funds and insurance companies and savers.
Yeah, I don't know if that helps.
Maybe.
Thank you.
Look, I think increasingly we are seeing cooperation and the use of Chinese EPC contractors and accessing of Chinese debt through, it's called the shadow banking environmentally and export credit type funding. At the equity level, I think it's fair to say that it's really quite divided at this stage. I don't know of any of us who are co-shareholders with Chinese owners in any projects. I guess that's a little bit further away than cooperation at the build level and at the debt funding level.
Yeah, I think one thing to probably highlight with Chinese financing is that it's very tied to the involvement of other Chinese players. So you don't, I mean, you might get the benefit of the capital, but you are then constrained in terms of what your options are. And sometimes, you want to feel that you've got the best, selection. You have the freedom of selection to give value for money. This is part of the challenge.
Thank you. One question before we all go. Each of you, if there was one thing you would like to see changed to make things better for you in terms of doing projects, Yuri, what would that be? One answer, one sentence.
I'd just like to see everyone arriving with truckloads of checks and just hand them out.
I second the motion.
Emeric?
On the serious side, I think I'd like to see this local infrastructure and environment, the African infrastructure landscape, become more of an acknowledged asset class for international investors alongside local investors.
Thank you. Emeric?
I think pension plans, both here in Africa and abroad, need to better understand infrastructure as an asset class. And from our perspective, as a global asset class, I really think about the co-investing model, whereby, the best model will be you have more African pension plans and their asset managers really seriously doing more in this sector, and it will certainly make it easier to crowd in other foreign investors who really would like to share the risk and the rewards with African institutional investors.
Thank you. Upuyu?
If I can be Oliver Twist, I'll say two very quick points. First of all, I fully endorse what America said. I really think that there's a tremendous, potentially wasted opportunity if we don't get African pension funds investing in infrastructure. So we've got to find a way to give them the comfort, create the products, etc., to really catalyze them into the market. The second thing is really that because infrastructure relies to a large extent on the role of governments, regulators and other parastatals in solving that problem, I just pray that they will truly be able to see the criticality of that consistency and building confidence. It's the lack of it that to a large extent is constraining capital coming into Africa.
Tosin?
Yes, like I said earlier, I'd like to see on the part of government across the region some more skill in terms of helping to fast-track conversations around infrastructure development. Definitely, I'd like to see governments invest in skill acquisition.
And Pierre?
Yeah, so one, definitely tapping local markets and local players more effectively, and two, finding better feedback loops where we would learn from you, what would help you invest more and more effectively, and then we and others can work with government and other parties on helping improve this enabling environment.
Well, ladies and gentlemen, you've heard it all. I hope you've enjoyed the session. We've come to a close for today. Thank you.